Welcome to the Farming Without the Bank podcast, the show with a no BS approach to money, hosted by a farm strategy expert and authorized IBC practitioner. Join us as we get real and expose the flaws of traditional financial institutions in order to help farmers take control of their finances, create peace of mind, grow their wealth, and leave a legacy. Now, here's your host, Mary Jo Irmen.
Hello, and welcome to today's podcast. Thanks for tuning in yet again. I truly appreciate the fact that you guys keep coming back for more. And welcome if you have just found our podcast. And maybe you're getting caught up on all of them, so you're back. Either way, thank you for being here. Hey, I just want to talk to you a little bit today about investments and life insurance. And I had a recent call that brought this to attention and thought, you know what, there's probably a whole bunch of you out there that are running into the same thing. And so I wanted to just kind of touch base on it because we get this a lot in the infinite banking concept world. And people try to compare this to an investment. And so people will come to us and say, hey, my investment guy told me that I should be putting money in a Roth, or I should be contributing to my 401k, or I should be putting money in an IRA, or I should be buying term and invest the difference. And so I just want to talk to you a little bit today about, is that the best option? Are they comparable? What should you look at? And so I just want to share the story of the client that I just had. And it's interesting because they came to me and said, you know, my cousin is trying to tell me that I should buy term and invest the difference, and I should be putting that in a Roth IRA. And while I think the best option for an investment is a Roth IRA, we have to look at why we want to put money there or why we want to put money into a life insurance policy. And so when we look at the investment, my first question is, what do you want to do with that money before you're 59 and a half? Because once you put it there, you do not have an option to take it out. And if you take it out, you interrupt the growth of that investment, right? So now you've got this money in your IRA, in your Roth, whatever it is, and you want to have access to it. And now you have to go and take it out, which interrupts the growth. And then you have to take it out with a penalty. And if it's anything except a Roth, you're going to have to pay tax on the growth. In a Roth, there is a penalty if you take it out before a certain period of time. And so it's just not as liquid as we want it to be. And it's interesting because when my clients come to me with this issue, I say, well, what do you want to do with that money before you're 59 and a half? Well, they will either want to buy land, buy apartments, take vacations, put braces on the kids, buy cars for the kids, buy new cars for themselves. Maybe they want to invest in a business opportunity or start another business. If you are an opportunist and you want to create more wealth before you are 59 and a half, putting money into an investment is giving up the liquidity of that money. You don't have access to money. So if you put it into an IRA, if you contribute to a 401k, if you put it into a 529 plan for the kids, whatever it is, you have given up access to that money. The kids can't use it or you can't use it. So what good does that do if you want to take advantage of an opportunity? It doesn't do you any good because it's not liquid. It's not accessible without penalty or taxes in most cases. I'm talking very general here. So those of you that are investment people listening, get your, panties out of a bunch and just be open-minded about this. There's going to be penalties or taxes in every tool outside of the whole life insurance. And if there's not, please let me know what that tool is because I would love to look at it. But if I have to interrupt the growth, if I have to pay taxes, if I have to pay penalty, we can't compare those tools or those investments, because those are truly investments, we can't compare those to a life insurance policy, which is not an investment. A whole life insurance policy is not an investment. And if you're going to use the word investment, I'm going to correct you. It is life insurance. It allows us cash value. It allows us this living death benefit that we can use while we're alive. And if you are not new to me, you've heard me talk about this before, life insurance is an and asset. We can put money there and we can use that money without penalty, without tax implications. We can use that money so that we can buy land. We can buy tractors. We can put kids through college. We can buy cars. We can lend money to other people. We can buy rental properties. We can start businesses. We can do all of those things while our money stays in the policy, continuing to earn interest and dividends. If we put that money into an investment, an IRA, a Roth, a CD, that is an or asset. We have to put money there or we buy the land. So we have to make that decision. Do we want to take advantage of that opportunity, or do we want to put money into our investment so we can have money at 59 and a half? Those are things we need to talk about. Those are things we need to think about. And it's amazing to me when clients come in and I say, well, what do you want to do with that money before 59 and a half? Nobody has asked them that. I've had a client tell me that we are the first person, or I am the first person that has ever asked them what they want to do with that money and what opportunity. Do they want to start a business? Do they want to buy another business? Do they want to buy land? Are you going to farm? What are you going to do? And they said, our investment guy has never asked us that. They just always want to know when we want to retire. They don't ask us what we want to do before we retire. It had never crossed my mind that is not a question, because I, by nature, am an opportunist. I am very entrepreneurial. I have had businesses forever. I have always been doing something to create more income or a better income, or saw potential for something and taken advantage of that. And so if you're working with a financial advisor who doesn't understand that because they're only planning for the future, they're not considering how you can create more wealth today while you're still in your peak years, they're not going to ask that question. They're not going to look at the fact that you need liquid money. So what are we doing as a whole? As a whole, we are giving up the opportunities for retirement. We're giving up the opportunities for risk of the market. We're giving up the opportunities for a penalty and taxation later. Who does that benefit? Not us. It might benefit the government because they get more taxes later, because you don't have the deductions later. If you're a business owner, you don't have the deductions later. If you're a homeowner, guess what? The kids are gone. They're no longer a deduction. Tax brackets usually only go up. They don't come down. Where are tax brackets going to be later? Those things need to be considered. But we are looking at that going, okay, well, this is what I need to do for retirement. And then I come along and say, well, what do we want to do today to create an infinite return on that money? Because if you can leave it in the policy to earn the return and the dividend, are you able to have a return on land you buy, on a business you start, lending it to other people? There's other opportunity there that is probably going to be extremely beneficial for you, right? But nobody asks us that. Nobody thinks that way. And it's nearly every client I have has to be reminded that they have access to this money, that they put money in as premium. And guess what? They can immediately turn around and borrow against it. It's like putting money into a savings account. It acts the same way, except when you borrow against it, it doesn't leave that savings account. Because we are so ingrained to believe that we have this or asset. We have to put it there or we have to do something else with it. And if we put it there, we can't touch it. That is what we are ingrained to think. But that's not how it is. If we put money in this life insurance tool, we can borrow against it. We can do all of these other things. And it's not our fault, right? It's not our fault we think that way. It's just that every other tool that we can put money in, that's how it works. It's just how it is. And so we can't compare this to an investment. It's not an investment. It's an and asset that gives us liquidity, control, and guarantees. So one, we have liquidity. We have the opportunity to buy all these other things or do all these other things I was talking about. We have control. We get to decide when we want to pay it back. We get to decide what we want to use it for, right? And we have guarantees that while it's in there, it's going to be earning us interest. The interest is guaranteed. There isn't anything guaranteed in a Roth. There isn't anything guaranteed in an IRA, in a 401k. Anything that's tied to the stock market, there's not a guarantee. Typically, in most cases, your universal life and variable and indexed life, which is also a permanent life insurance product, doesn't have a guarantee either. So if you have one of those products, don't assume that you are doing exactly what you need to be doing to best utilize the life insurance tool. So look at that, think about that, the fact that it's an and asset. What do we want to do today? What do you want to do today with that money while you are still in your prime working years and you can create more wealth? What can you do with that and asset while you're in your retirement years to create more wealth? Nelson always said, show me in the Bible where it talks about retirement. It doesn't talk about retirement. We have this preconceived notion that we need to retire because that is something that was created for us to get us out of the working system so all these baby boomers could come into the working system. That is not today's problem. Today's problem is that all the people that are supposed to be retired are still working because that investment didn't work for them. I have a client who came to me and said, Mary Jo, I did everything I was supposed to do. I saved 20% of my income. I put it into my 401ks throughout the years. I know exactly it takes us, I think this number was $73,000 a year to live. He knew exactly how much money it cost him to live every year. He bought a rental home for his kids to live in when he went to college or when they went to college. So now he's got 1 or 2 rental homes because those are what his kids lived in with their friends, and the friends then paid them rental income, okay? So his kids were essentially getting rent for free or a very big discount, and he owns this home. So now he's coming into retirement, and he's got millions of dollars in his 401k and his IRAs from past jobs. He's got rental income from his rental properties, and he's going to have land rent from farm income because he doesn't want to ranch any longer. Because he's getting older by himself. It's harder. So he wants to get rid of the cows. He said, my financial advisor is super excited for me because I've got all this money and I've done everything I'm supposed to do. But my accountant is a little bit concerned because I'm going to be in some massive tax trouble. His income from renting land, renting his 2 apartments, and one business or one company he worked at had a pension. And Social Security. That income is going to be more than the $73,000 that he needs to live. And he said, that's fine. My money can sit in this 401k and IRA until I am 70 and a half. And at 70 and a half, I have to take what is called a required minimum distribution. So the government has this calculation that says, how old are you? How much money do you have? And how fast is this investment going to grow? Based on that information, they then calculate how much money you have to take out of your investments, or you are taxed at a 50% value of what you should be taking out. So for example, if I remember the numbers correctly, his were around $160,000 is his required minimum distribution. If he doesn't take it, he then gets taxed at 50% of it. So about $80,000 would be tax. So he either pays the tax or he takes it and he incurs more income, which then may put him into a higher tax bracket with no deductions because remember, he got rid of the cows. He said, I was doing what everybody told me I should do, and now I'm going to be in tax trouble. How do I get this money out of the IRAs and into life insurance where it's income tax free? Like, you can't. It doesn't matter when you take the money out of the IRA, you have to pay tax on it. Or the 401k, you have to pay tax on it. You got the tax break ahead of time. If you're going to ever take it out of there to put it in something else, you have to pay tax on that. If you roll it to a Roth, because some of these IRAs can be rolled to a Roth, if you roll it to a Roth, you still pay tax on that. You can't avoid the tax. You just kicked it down the road for the last 35 years. That is the asset everybody wants you to have. That is the investment. And he's really angry because he didn't know about whole life insurance. That is where he would have been putting his money. And guess what? He could probably have more rental income. He could have probably bought more rental properties. He could have maybe bought more land, more cows, while he was in his prime working years. Now he wants to slow down. He wants to get rid of the cows. Or he's now going to have cows on shares with somebody so he can still have those expenses. Maybe we're still going to need to farm a little bit so we can still have some of those expenses. So think about that when you are looking at this life insurance and you're trying to compare it to another investment or a investment, not another investment, because it's not an investment, right? But when you're trying to compare it to something else, if you are trying to compare it to an investment, does that investment have liquidity controls and guarantees? Liquidity, control, and guarantees. If you don't have that, you can't compare them because they are not the same tool. Life insurance is a tool to the concept, and the concept is infinite banking. And guess what? Why did Nelson name it infinite banking? Because there is an infinite amount of things you can do with this and asset. An infinite. And you can make an infinite return on it with those other things in addition to the life insurance policy. So it's the infinite banking concept with an and asset. I don't know where else you're going to find that, folks. If you do, please let me know. Please, please, because everybody thinks I'm a kook here talking about life insurance. Well, not everybody, but some people. And I just want you to understand that when we start looking at what you can do with that money, it doesn't matter what the rate of return is in an investment. Because what can we do today with that money instead of waiting till retirement to pay taxes or to access it with penalty before then? What are we giving up to have that IRA, 401k, 529 plan for the kids? And let's just talk about that real quick. The 529 plan for the kids, you're putting that money there and it has to be used for schooling. Or there's a few other things, right? But there's limitations on what that money can be used for. What if that kid doesn't go to school? Now we put the money there. What if the market crashes before they go to college, like the year before they go to college, and now we don't have time to make up that money? What if they want to buy a steer and show it? What if they want to buy a horse and show it? What if they want to buy a lamb and show it? Right? What if your kids are in 4-H? Or what if your kids want to start a little business? Use that money in a life insurance policy to do that. Create their 529 plan inside of the life insurance policy. And it gives them opportunities. If your kid is an opportunist, it gives them the opportunities. I have a 14-year-old. She's been selling stuff at school since she's been a second grader. It is unbelievable to me the things that she can sell that people will pay money for. We had to stop it. We had to stop it when she was selling peanut butter chocolate candy. I'm like, ugh, please don't take those to school. Somebody's going to have a peanut allergy and we're going to end up in court. You're going to kill somebody. We can't do that. So we did have to rein in the parade a little bit there, but it's going to give her opportunities. I already know based on that information. And at 14, she's like, Mom, how can I have enough money so I can buy a house when I graduate? Well, you're going to have to take advantage of an opportunity. You're not going to do that working for somebody in town. You're going to have to maybe sell stuff on eBay, maybe have an extra job there or sell this, or I don't know. I'm not quite that savvy on all the internet stuff. But if that's an opportunity and we have to put some money at it, now we can use the money from the life insurance policy and we can borrow against that policy to start a little business for her. Fantastic. I couldn't do that if that money was in a 529 plan. So think about that. And asset, not an or asset. Liquidity, control, and guarantees. That is what we're talking about, folks. That simple. It's not complicated. It's so simple, you might think that it's too good to be true. Yet it's not, because it's been around for 140 plus years. So I hope that helped you a little bit to get your mind around some of that stuff, or to help you answer some of those questions when you're talking to somebody that really likes investments, and to help you think about where you need to go and what you want to do during your working years instead of waiting until you're retired. If you have questions, if you have concerns, if you have comments, please let me know what they are. If there are things that you want to hear, please let me know what that is. I always appreciate hearing from you. And thank you once again for tuning in. I will talk to you on the next one. Have a good one.
Thanks for listening to the Farming Without the Bank podcast. We hope today's episode has inspired you to take control of your finances in new ways. Don't forget to check out our website, farmingwithoutthebank.com, and engage with us on our Facebook page, Farming Without the Bank. Join us next week as we smash more financial myths and empower you to accomplish your financial goals.